Okay, the housing market is crashing around us. All the headlines are saying house prices are crashing down and the housing is going to melt down and it's finally going to be affordable and you're going to finally be able to buy a house because you're going to scoop up a deal because all this inventory is coming on the market and prices are starting to come down. But is that really what's happening? I'm going to break into the data today. I went through like 50 charts and graphs and data, and we are going to look at the actual data, see what the housing market's going to do. I don't want to waste your time. This is a lot of information to go through today. Let's get into it right now.
Shut up and sit down.
Just in case you're new here, this is the Retire Mentality channel. This is a place where I want to change your mentality about retirement, about investing, about real estate, about retiring early, about the FIRE movement. If any of those things are important to you or things you want to learn more about, then you are in the right place. Welcome, my friends. Consider subscribing to the channel so you can get more of this content, and give me a big thumbs up if you would, because I went through a lot of data to get this information for you guys today. So please reward my hard work with a simple tap of the like button down there, and that'll be a big thank you to me. Okay, let's get into the data. All right, so we are going to, I'm going to bring you into my computer with me today. We are going to the Black Knight site. If you go to this, this is the site, blackknightinc.com. Go over here, click data reports, and then click July data, and then you can click the charts, and this is where I got all this information from. You can go research it all yourself. I'm going to break out about half of the charts that they actually have on here, but I went through all of them, and these are the ones that I think are the most important. Okay, so let's get straight into the first one. This is the July overview statistics. So this big red arrow here at the very beginning, delinquency rate up 1.98%. Oh my gosh, delinquencies are up 2%. The world is crashing. But wait, if we look down here, the national delinquency rate rose to a total of 2.89%. So serious delinquencies, those are over 90 days. So the total people that are up to 90 days late on their mortgages is less than 3%, and it just rose 2%. So that means it was below 1% to start with, which is just like historically way down low in the depths of the belly of like almost nobody's late on their mortgage. But like here, foreclosure starts down 25%. That's because nobody's late. So the people in foreclosure is also down. And then prepayment activity down 18%. This I don't think is a very important number. This reflects the fact that nobody's refinancing their mortgage anymore because interest rates are up. And we're going to talk at the very end of this, we're going to talk more about interest rates and how interest rates affect what happens if prices do come down. If interest rates go up, it could offset that. But I'm going to break into those numbers at the very end of the video. So let's go to the next slide here. This shows what the actual delinquency rate is on people's first mortgages. Some people might have a HELOC or a second mortgage. This is just delinquency rates on first mortgages because typically this is the big one here, and you're not gonna, if you're late on this one, there's trouble. So look at this chart. Here's 2007, 2008, 2009, leading up to the big crash. We had a 10% delinquency rate in the height of when the mortgage meltdown, the recession, the great reset, whatever you want to call it. And so then it's been falling because banks tightened up their lending requirements. So all the way down until the day the pandemic started, they were just crashing down, still at about 3.5%. And then boom, COVID hits. They spiked back up to about 8% of people who were late. Doesn't mean they were foreclosed on, it just means they were late on their payments. Then they instituted forbearance, then people realized that maybe the world wasn't gonna end, and people started paying their mortgages again, all the way down until right now, where we were down here below 3%, and then this big 2% raise just got us back up to 2.89%. So that is where we are. We're still, look at this, we're below any of these historic low levels. We're at a historic low level dating, this goes back to 2001. All right, so this is the important one here. This is what's getting all the headlines. This is the home price index. This is what housing prices have done. So look at here, leading up to the big crash. They were going up at 10%. This is month over month changes, and then boom. So then you can see here in this month they were down about 8%, and then the next month they were down about 3%, and then the next month they were down about 12%. So all in all, there was a couple months in here where they went up a little bit. So all in all, they say houses lost about 33% of their value during this crash back in '08. Now we look at, this is just what's been going on in the last couple of years. This is starting in 2020. Look at these appreciation levels month over month: 10%, 10%, 5%, 20%, 5%, 20%. So just this year in most markets, house prices are up about 30% just this year, plus another 20, 30% last year. So housing prices have been skyrocketing. We all know that. That's why everybody's hoping for a crash. And so look, wait, what does this show on this chart? What is this big dip down here? For the first time since 2008, housing prices dipped. I've been saying there could be a dip in prices. How big is this dip? 0.7, I had to lean in, it's so small. 0.77%, so about 0.75% prices dipped. Okay, well, that's a headline maker. But when housing prices are up 30% so far this year, a 0.77% dip isn't going to make a huge dent in the market. If it continues on a downward trend, then we could see prices start to actually come down. Another thing I want to just make a caveat here, house prices dipping, they're looking at sales prices, so it's hard to equate that to like a price per square foot. I look at house prices coming down when the price per square foot is coming down, because people have been asking stupid, ridiculous prices for their properties because there was a buyer's frenzy and people would just pay whatever they wanted. They all had FOMO, and so they were asking stupid prices. And now those prices are coming back down to reality. People aren't getting stupid, crazy prices. It doesn't mean prices are coming down. It means people aren't overpaying. So there's a difference there. I digress. Let's go into the next chart. This breaks out by month. So if we look here in January, up 1.33%. February, 2.29. 2.72, 2.55, 1.48. So this is the month over month gains in equity. So that is about 11% so far this year. If you look at this chart. So a 0.77 dip means properties are still up 10% this year. So when I start talking about mortgage prices, we're going to use this 10% number again in a minute. So let's just go through here. This just shows where the worst areas are getting hit with declining prices. San Jose down 10%. So on a national, if their averages of appreciation so far this year would equate to this chart, they would be back to zero. So even though they're down 10%, I mean, they're be zero for this year, but then they still be 20% higher than last year. So just keep that in mind. Here, this shows the most affordable places you could live. So if you want to find the place where you can have the lowest debt to income ratio on your mortgage, you can move to places like St. Louis, Detroit, Kansas City, Cincinnati. And then the least affordable places, this is no surprise, California, Washington, New York, Miami, Las Vegas, blah, blah, blah. So now this is another important chart here. Negative equity rate and total market, the CLTV. CLTV stands for combined loan to value. That's if you have a first mortgage and a second mortgage. So this shows you when, like in 2008, when the market crashed, it's because people were upside down in their houses. They owed more than the house was worth. So they owed this much and the house was worth this much. So this chart here shows negative equity. So back in the crisis back here, 24, 25, 28% of people were upside down in their mortgages. That's why they walked away from their mortgage and their home and they went into foreclosure, because they owed more than it was worth. So they couldn't sell it. They would have to sell their house and come to the table and give the buyer like give the bank $30,000 and not have their house. So people just said, screw it, I'm out. And they got their crap and they left and they just got foreclosed on. So you can see since that happened and the banks changed their lending requirements, now almost nobody has negative equity. 0.06, 0.04. That's where we are today. Less than half of 1% have negative equity. And this must be people who like bought a house last month and then this 0.77 decrease in prices just happened. And they must have also had to get 100% VA loan. I don't know how you can have negative equity in this market. It makes it absolutely, these people did something wrong, but very few of them, 0.04% negative equity. So in this chart, they're projecting what would happen if there was a 5% price decline. Well, then less than 1%, 0.9% of people would have negative equity. And if the market crashes down 10%, 1.9% of people would have negative equity. And if unprecedented, the world crashes around us and the real estate crashes down 15%, 3.7% of people would have negative equity. That is not enough to crash the market, in my opinion. So it's very low numbers here. You can see the averages before that. Well, we'll just go to the next slide. Let me show you this. So here's how much properties have appreciated. These are the markets with the highest home price growth rates. This is the annual price growth rate. So Tampa, 28%, Miami, 27%, 24, da 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 da. The worst performing markets, look down here, San Francisco, the worst one, it's still appreciated at 4%. So a 4% decrease in prices would get you back to zero in San Francisco. A 5-10% decrease in prices in these markets where you really want to live, this is where people were moving to. A 10% decrease would you'd still be paying 20% more than what you would have paid last year. So a crash that is unlikely to happen is not even going to get you to where you could have bought 12 months ago. So everybody who's been waiting for this crash, unfortunately, might be in bad shape. So the other thing people are wanting us to get from a seller's market to a buyer's market. So how do we get from a seller's market to a buyer's market? We do that with inventory. That's what's been driving these prices up, zero inventory. So here is a look at how many months of inventory we have. I'm going to show you this little chart here. This shows you a seller's market is when we have between 0 and 3 months of inventory. That means how long a property typically sits on the market before somebody buys it. So when properties sit on the market for more than 3 months, then inventory starts to stack up. So when you have between 4 and 7 months of inventory, that's a neutral, balanced market. That's really where everybody should want to be. And then in a buyer's market, this is when there's a flood of properties on the market. There's no buyers out there. This is what happened in 2008 when we had all these foreclosures and there were more homes than anybody could buy, and people weren't buying because everyone was broke. So you got to have more than 7 months of inventory before you get into buyer's market territory. So go back into this chart. Here, like you can look here, we had 12 months of inventory back when stuff crashed back in 2007, 2008, 2009, 2010. We were still sitting at 12 months of inventory right here. Excuse me. And then things started to settle down. People started buying, getting back into the market until we get to this all-time record low right here of 1.7 months on the market. This is the buying frenzy that we've been in. And now that inventory is starting to stack up a little bit again. We're at 3.1%. Well, let's go back to this little chart here, handy dandy little picture. 3.1% puts us right here. And so we still got to get a long way. We got to double the inventory where we are now to get back to 7 months of inventory to get into a buyer's market. So that's a long way to go. Okay, next slide. Tappable equity of U.S. mortgage holders. This is an interesting and an important slide also. Now, this says tappable equity is defined as an estimated amount that could be withdrawn while still remaining an 80% or lower loan to value ratio. That means if somebody did an 80% cash out refi, they still have 20% of equity in their house. This is how much cash they could actually pull out of their house. You can see like the average, if we drew a line through here, the average of this would be about $4,000. We're 3 times that at $12,000. So somebody could do a cash out refi, pull out $12,000 and still have 20% equity in their house. So the importance of this is that if somebody was to have to get foreclosed on their house or be upside down, prices would have to come down 20% plus $12,000 for people to be upside down like they were in 2008. That's why this is important. The other thing people said that was going to crash the market and make a flood of homes come onto the market and make prices just come tumbling down was the forbearances. So this chart here tracks how many homes are still in active forbearance. These 3 lines down here, this is Fannie Mae, Freddie Mac, and other, which could be private equity loans or private money in the market or whatever. So this shows the total amount of loans. So you can see how many are in forbearance here. We're just screeching to a halt down here at almost 0. So there's not that many left in the market that are going to come on and flood the market. Those people all got out of it, and this chart shows that a little bit better. This green part shows how many people were in forbearance and then started making their payments again, and it worked as it was supposed to and saved their butts. This big gray part down here is how many people have sold their house and got out of the loan altogether. So this is 52% and this is 32%. So that's 84% of the forbearance loans either just used the program, got out of it, or sold their house. So that leaves 16%. This 16% is divided into these little squares here. Some people extended, some people are still paying it like they're supposed to. Some people went to loss mitigation, and there's a little slice down here of people that got foreclosed on. So, all right, that's the data. That's not my opinion. That's the data on what's going on in the market. The other thing is interest rates I wanted to talk to you a little bit about. So let's look here at the median house price in America. I'm going to do some numbers for you. So if prices came down 10%, what would happen? But maybe interest rates are going up. They're going to raise interest rates again, they're saying. So the median home price right here, it says is $440,000. All right, so let's go into my handy dandy mortgage calculator here. $400,000 if you put 20% down, that gives you a $80,000 down payment. So start saving up for that. That gives you a loan amount of $360,000 at a 5% interest rate. Gives you a mortgage payment of $1,933. Okay, let's say the market crashes down 10%, and that puts excuse me, the median home price at $400,000. So that is going to give you loan payment. That's a mortgage payment of $320,000, and that's $889. Oh no, that's not. But let's say let's say interest rates go from 5% up to 6%. A 1% bump in your mortgage rate puts your payment at $1,913. So a $40,000 price drop, 10% at that $400,000 price point, a 10% drop in prices is negated by a 1% rise in interest rates. You're exactly where you would have been. So if prices dropped 10% and rates went up 1%, it's a wash. So for people who've been waiting for prices to dip, well, they might dip a little bit. I doubt they're going to dip 10%. And even if they do, since rates are going up, it's not going to save you any money. So I've been saying for 3 years that you guys should be buying houses and not waiting for this crash. And everybody told me I was stupid. So leave me a comment down below if you still think I'm stupid, or you start to say, gosh, Jeff, you were right. Maybe we should have bought a house 3 years ago when you told us that this was not going to happen. So leave me a comment down below if you every time I ask somebody, they tell me I'm stupid, I say, well, what do you see that's going to make the market crash? And there are a few things that could potentially be detrimental to the housing market. The recession could just dip super big. There could be massive layoffs. Like right now, unemployment is still very low. Some banks are starting to say they're going to start laying some people off. So if we start to see massive layoffs and a huge, deep, wide, long recession, then housing prices could start to be affected. But as for now, as long as the labor market and unemployment stays low, I don't see us having a big crash. But leave me a comment if you disagree with me. Give me a big thumbs up or a big thumbs down. If you like this video, just some sort of appreciation for all this work I put in here, because all this data, that's not my opinion. That's people way smarter than me collecting the data, and I'm just showing you what it says and then interpreting it for you. So give me a thumbs up, subscribe to the channel, and I'll see you in the next video.